everybody. In this video, I'm going to be going over the burn rates, both the gross and net burn rate, what those are and what they really mean to your franchise. And I'm also going to be going over runway and what is that and why is that important to your franchise. So let me share with you here. I have an example. This is from a Gutters franchise. I just took a random December P&L so we could look at this and go, in reality, like in real life, how would we come up with the burn rate and the runway? Quick definitions. The burn rate is simply how fast is your franchise going through your cash. So it's essentially a sum of all of your cash expenses, but also considering, are you taking draws every month? Are you paying off debt? You have a loan, perhaps an SBA loan. All of that's going to factor in as well. So for ease, I color coded the P&L so you can see the income accounts, the cost of goods sold, the kind of direct expenses that go into your product or service. And then all of the other below the gross profit line expenses, all the other expenses to run the business, utilities and rent. So I summarized those three sections here. So I summarize and rounded. I think it's easier to look at the numbers if there's not cents and dollars. So 63K in revenue for the month, 35K in cost of goods. Yeah, so that's your total expenses. So here we can see if you just take your revenue less your cost of goods sold and your expenses, that's 75K compared to 63K revenue. And that makes sense because if we look at the P&L, you see there's a little negative sign. This is a loss of a little over 11K for the month. So how do we get the burn rate? Well, one thing that we're missing here is our draws. Are we like habitually taking money out of the LLC, and then debt payments, and specifically the principal piece. Whenever you make a debt payment, there's principal and interest. Interest is already being captured in the P&L, but not the principal. That only shows up on the balance sheet. So let's say this particular client is making $3,500 a month in principal payments on debt, and let's say that they're drawing 10K a month to their personal for their personal needs. So the gross burn rate in this case, the gross burn rate is how much cash you're going through, regardless of how much you're doing in revenue. So in this case, it would be your cost of goods sold plus expenses plus your draws and debt payments, and the business is going through every month over 88 grand in cash to exist. And then the net burn rate would factor in revenue, so we can take the revenue less the gross burn rate, and there we can see actually. So we are burning through a net 25K. If we factor in the money we have coming in, we're burning through a net 25. Now, runway is how long, depending on how much cash you have today, how long are you going to last? Like how long can you have an 88,500? Really, let's look at net, a 25,500 net outflow every month. Well, let's say that your December 31 cash is equal to 150K. What that means is that you could last at these levels. If you take the cash divided by the net burn, you could last for about 6 months at these levels. And what that does is it gives you an idea of like, okay, I have 6 months to make some change, to pivot, to figure out how to get either my revenue up or my expenses down. But it gives you that idea, like if you just kind of consistently went from here, how long would you last? I hope you learned something from this video. If so, please give us a like and share the video. Maybe we can help some more people. See you in the next one.